Welcome to today's Corporate Venturing Insider Series. Today we have Crispin from EnBW Ventures. Crispin, welcome.
Hi, Nicolas. Thank you for the invitation and great to be here. So greetings from windy and rainy Germany, where I think today renewables will make up close to 100% of the whole electricity production.
Because it's very windy and your mothership is all about wind. I know that, so I'm sure we will go into that afterwards. Crispin, I always like to start asking by your journey into corporate venturing.
Yeah, that's so that's a question where I can probably talk an hour about, but let me just try to get sort of the biggest points ready here. So first of all, what I did in the beginning, or let's say by training, I'm a chemical engineer by training originally, energy is sort of really the topic of my whole business career. It maybe even started a little bit earlier, but maybe I dive into this when we later on probably talk a little bit about technology too. So maybe I dive then into this. So chemical engineering really focused on energy technologies. So all around energy generation stuff. And actually, I got also very excited about renewables very early in my life. But then when I studied, I noticed, it's not yet really commercial. So it was in the early 90s, and it was just not yet ready. And even when I was then finishing my studies, I decided not to start in renewables because I thought it's just too small yet, so I cannot really have an impact. Therefore, I looked for, what would be sort of the bridging technology into renewables? And I thought that this could be natural gas, so gas business being less carbon intensive. And so I entered into the gas industry. And so if I would put my career into sort of the big topics of my 26-year career right now, then it would be, the first piece would be portfolio management, and this natural gas business was sort of big, large contracts, managing and optimizing natural gas flows and imports and storage and all this. But also later on, I did electricity trading with a famous American company that doesn't exist anymore, but Enron has many stories, so that would be another topic for itself. So this was sort of the first piece. And then 2002, I thought, now renewables are commercial enough, so let's do the step change, go into renewables. And I joined a young, small, growing very fast wind energy project developer and technology company, so also manufacturing wind turbines, called Repower Systems at the time. Went to the famous Neuer Markt in Germany. And there I was doing business development and sort of basically exchanging large salary with a lot of responsibility. That was the trade at the time when you went into renewables. I loved that one. And then this business was going bigger and bigger. And I saw, I need to change to the big players. And so I went to one of the largest electricity generator at the time in Germany, RWE. And they were putting all their renewables into one unit. And I was lucky enough that I could sort of help there a little bit. And so this was sort of the second big piece. And then the third big piece is corporate venture capital. And so the question is, how did I get there? Well, I saw sort of the renewables and all the business sides. And I saw how large corporations are operating and also small corporations, because I witnessed the company sort of growing from 150 to close to 1,000 employees within 3 years. So I witnessed this within. And then I thought, I'm not the type of guy, I'm not a founder in that sense. I'm not an entrepreneur, but I'm a portfolio manager. So I think maybe I can add value there. And I was fascinated by entrepreneurial drive, well knowing that I'm not one of those, but I thought it's just great. So working with them is fantastic fun. And so my translation was, I wanted to have sort of an impact on this renewable energy question and sustainability. I wanted to have an impact on large corporations, because it's great if you have a big tanker and you steer it a little bit in a different direction, then it's just amazing what happens. And I was convinced that the real innovation is happening actually in small, fast-moving units. And what do you do in order to have the luxury to work with all these three? That's corporate venture capital. And now the piece that, of course, is missing in this story is you need to be lucky. And my point was there actually was a board member of the renewables unit within RWE at the time. And he was basically asking me, Crispin, we're looking for something that is innovative, but commercial, and it should scale. So it's not R&D, and we want to sort of push the renewables world further. And my answer was, what you need is a CVC unit. And this was 2007 when we had this discussion, so many years ago. And honestly, this was the time where in Germany, like 2001, 2, 3, all the larger corporations had tried CVC and failed miserably, basically starting it in 89, 99 in this huge boom and closing it 2002, 2003 in the bust. So this classic buy high, sell low. So these were big capital losses at the time for the corporates. And so they were not very eager to start, but then came the new class of CVC funds being much more focused, not generalists, but being the big party, but much more focused from a topic point. And this is when I actually started then EnBW Venture Capital as my first CVC. This was a thesis about a clean tech thesis, a lot of hardware also involved. Later on, switching more to enabling technologies, because you know what happened to all these clean tech funds in the first phase. So and then the second CVC was then EnBW Ventures, and there this was actually just the head of innovation reaching out, talking to many investors, and he very much liked what we had built in EnBW Venture Capital, and he basically told me, okay, Crispin, we have a commitment. We want to do this. We have many other innovation activities already, but we're missing on the investment arm, on the external, on the real open innovation arm. And then we discussed, and this was the start of EnBW Ventures 2016. Then.
Very nice. And I will be asking what you learned from the first CVC to design the second CVC. But let's start from the beginning. Your background in chemical engineering is very relevant for renewable energies. I mean, you see a lot of that. Why or how does that make you a better investor? Or do you take anything from that background into becoming a better investor?
Well, being a better investor, I don't know. This is a high aspiration. I would say there's many traits that an investor needs to have that has nothing to do with chemical engineering. But putting it on the chemical engineering piece, and there's not only this piece, but I would like to add another one. But chemical engineering, or being an engineer in general, I mean, you're taught or you're educated as a problem solver. What you're looking at is efficiency, conversion rates, the right technology to employ, can it be realized? So you're always on the realization phase, not so much on the I'm dreaming a dream phase. So I think this toolbox is very helpful, especially, of course, in the energy context, because even today, I think, there's huge discussions, and let me make one very specific example, and I hope that I get it over in a simple way. There's again and again the discussion about if renewables ever can sort of change the world, because they only bring a very small piece in the primary energy consumption. And this is exactly where my old education just helps me a lot, because what we need to look at is not primary energy consumption. That's just the wrong metric. Why? Because a huge chunk of this primary energy consumption is heat loss that we don't need. So if I take a gasoline car, I mean, only 20-25% of the energy that is in the fuel is actually used for moving the car. The rest is going with heat and goes into the atmosphere. And therefore, I think it's the wrong metric. And if you have a chemical engineering background, you know that there's secondary sort of energy generation and the usage of energy generation, which is called exergy at the end of the day. And exergy, electricity, for example, is 100% exergy. Electricity you can use for whatever you want it, and you have a very, very good conversion. And therefore, electric cars, for example, just have a huge advantage because they are much, much more efficient, 3 times at least more efficient than the ICE cars. Now, still, you need technologies and material advancements, because without the huge progress in batteries, you could never sort of do this. But for example, if you take a 100 kilowatt hour battery, which is the largest battery or the biggest size that you get in a car right now, if you translate this into fuel, it's basically only oh shit.
Okay, we are back, and you were talking about the system end-to-end efficiency.
Yes, I'm very, very sorry. This was my connection here seems to have an issue, and I don't know what it is. So I hope that it doesn't happen again. But
We will manage.
We will manage. Yeah, this is live, right?
We solve problems.
Very sorry for that. Yeah, so basically, you end up 100 kilowatt hour battery is just sort of something like 8-9 liters of fuel, and the car is driving 300-400 kilometers with this. So this shows this incredible efficiency, and this is why when you come to investment topics, of course, it's much easier to judge. Okay, can this scale? Is this efficient? Is this a superior product? In order to go into the sustainability direction, but also at the end of the day, it has to be cost efficient. Yeah? People must be able to pay it. Sustainability, longevity, performance, all this comes then together. But this is an example. So thinking in these conversion rates. But I must add that I was lucky enough to later on also add, in my generation, it was sort of still. Like MBA was still sort of high aspiration and value, and I was lucky enough to add to my toolbox also an MBA later on in parallel to working, so GSB Chicago, and actually if you're a chemical engineer, I think it helps a lot if you also have the economical training of an MBA, and this brought sort of the things together, and this helps me. And still, there were so many lessons in the first years and up to today that I had to learn before I would qualify myself as an experienced investor on the way. So that was just the start.
Very nice. And one thing that I also got from your career before getting into corporate venturing is you've always been in this project that needs to scale. And today, you invest in projects, I think, mostly in Series A, that are already about to scale. How much of that experience helps you to identify the right projects to invest in, but also help them afterwards?
Yeah, I think having a view on or having sort of lived through on your own also the issues, like I mentioned, repo systems at the time, that was sort of growing also from the people side, from the employment side like crazy, gives you an experience on what it takes, on what sort of sacrifices and also what focus and effort is needed to actually. I'm sorry. I don't know, but it doesn't work here. You still hear me, I guess?
I can hear you.
I cannot tell you what is happening here. You can't see me right now, huh?
No, I think we're losing your camera every so often. Do you want to move to your laptop instead?
You mean moving from the system? That will maybe then look differently, but so it's really
It's up to you.
surprising.
I just feel like maybe it's your system which has a security issue. This morning we also had video conference using Teams, and every 15 minutes it would just drop, and we had to restart every time.
Yeah, if it would be 50 minutes, it would be fine, I guess. But the problem is it's now happening basically every 2-3 minutes, which is really strange. Yeah, so maybe let's try it. If it drops once more and then I switch to it, it will not look very nice. But it doesn't matter. At least it wouldn't be interrupted.
Okay, no problem. I'll move to the next question. What I find actually, okay, I'll wait for you to be, and then we will cut everything. So I think one thing I was quite impressed is you were asked to do innovation with something commercial, and then you came up with corporate venturing when it was so many cadavers from the past. So tell me how you got to propose that, and why were you not afraid to propose it?
Yeah. First of all, I think it's a trait of my character that I'm not very afraid to propose things, even if I might get quite a lot of opposition. I think that's also key of our job, because typically when we come up with topics and ideas and stuff, also from our entrepreneurs, it's still a minority opinion. So you have to withstand that the majority still thinks that this idea is maybe not yet right, or not sort of the majority thing. So I think that's a piece that you need to bring up as or bring with you as an investor. But I think also that as an investor, you have to be very careful. You should not always fight the trend, so you have to identify the trend when it's still a minority opinion, but when it's a strong trend. And as you know, we're investing as EnBW New Ventures on 3 megatrends: electrification, digitization, and decentralization. And this is for a purpose, because we see these trends being very strong, being multi-decade. And okay, I switch.
Yeah, I think it's your system. However smart it is.
Yes. Yeah. It's so smart and so modern that it doesn't work. So you can hear me. I need to.
I think it's actually better that way. Yeah, it's actually better. Now I can see your face and your expression.
Okay, so then we should have started like that. Sorry for that.
No problem. Let's start again, and let's start from the beginning. I think we will assume everything in the past is in the past. So welcome to today's Corporate Venturing Insider series. Today, I'm super excited to have Crispin from EnBW Ventures. I've watched him on LinkedIn, and he has always very interesting, sometimes provocative posts. Crispin, welcome.
Hi, Nicolas. Great to meet you, and thank you for the invitation. And yeah, greetings from rainy and windy Germany. We have basically today close to 100% renewables in the system, so that's pretty exciting.
So, Crispin, I always like to start with your journey. What was your journey into corporate venturing?
Yeah, that's actually not a short question to answer. So I can speak long about this question. So let me start just from sort of where I started as the education. So after school, I decided to go into or to study chemical engineering. But chemical engineering is a broad topic, so it was focused on energy technologies. And I was fascinated basically by the energy issue, or the question of how to generate sustainable energy from the very beginning. And that sort of drove me into chemical engineering. And there, well, I had to learn, of course, first what is the existing technology, because at the time, this was in the early 90s, renewables only played a very small role. So I had one course only about renewables. All the rest was gas, oil, coal, and all these things. But I thought, okay, that's good. If you know the existing technologies, then maybe you can contribute for the new technologies to really bring value. And yeah, so that was the first piece, basically closing or being a chemical engineer. Then there are, in my career, like the last 26 years, there are three major pieces. And the first piece I would qualify with portfolio management. So after studying, I thought, okay, it's maybe not yet time for the renewables. So what do you do? And I decided to go into the natural gas business, because I thought that could be the bridge to renewables, and it's less expensive. And there I actually went into the unit that was handling all the large contracts, import, supply, storage for Germany. And also later on, I was then changing to an American company doing power trading called Enron. So the older people know the company pretty well, not only for the good things, but it was sort of, I learned incredibly many things. It was a very dynamic and innovative. I mean, 7 years in a row, the most innovative company in the world, and then Chapter 11. So that taught me also a lesson very early. It's just being innovative is not enough.
Well, actually, in this case, maybe it was too innovative on the accounting part, right?
That's the point. Maybe you should focus your innovation on bringing value to your customers and not so much on optimizing your own books or something like this, or building very complex structures. But still, I mean, it was a crazy time, and many also people, like you can imagine, there were like 20,000 people in Enron, and then it went Chapter 11. So these 20,000 went everywhere. So afterwards, you had a network in all the energy companies. So still today, I bump into people wherever I am when it's about energy that have an Enron background. So that's pretty cool. So yeah, first piece. Second piece, then ultimately the renewables. So I went to a wind turbine project developer and manufacturer. I exchanged the good salary that I have before in the trading world and in the energy world to having a lot of responsibility. So I was responsible for the European expansion of a still small company at the time, developing wind projects and also having their own wind turbine technology called Repower Systems. And this business was growing and growing. So at the early times, 2002, I actually entered there. The renewables had in Germany, 3-4% market share, so still very small, but moving every day and every year a little bit forward. And as business grew larger and larger, a couple of years later, I saw that it's important to engage with the utilities because they were, at the beginning, they were not so big fans of the renewables, but then this changed. They started to embrace it step by step. And so I changed and went to the largest German power generator, RWE at the time, known for a lot of coal and dirty stuff. But they were putting all their renewables into one unit. So wind, biomass, hydro, and PV was basically inexistent at the time. And I was lucky to join there and then to sort of support a little bit in getting this off the ground. And this was also then the point where actually the impulse came for the venture capital world. So the third piece in my career is 16 years of corporate venture capital now. And that started 2007 when actually the managing director of the RWE Energy at the time basically asked me if I would have an idea. They would love to push innovation in the renewable space, but commercial, not so much R&D or technology driven, but more really on the execution side, on sort of making money with it and scaling it, and bringing sort of these different pieces that I had seen. So on the one hand, I've worked for a very large corporation. I've worked for a small, very strongly growing corporation. I had a sort of drive for the renewables, and then I had this large corporation that wants to invest into this. So the idea was not so far away to actually propose what you need is a corporate venture capital unit. And the funny thing, what then happened is sometimes in large corporations, if you propose something and they like it, then the answer is, please, you proposed it, now do it. And of course, I had no clue at the time. So I had a contact to some sustainable asset investors at the time in Switzerland, sustainable asset management, for example. But these were still small shops. And so I reached out to some US-based VCs because I just didn't know how to do it. Being a little bit sort of, I had this idea and I thought, okay, I have also a clear plan and an investment strategy. And then these US VCs, they talked to me and they gave me a couple of hints. And as in one of my posts I've written, I should have listened better, actually, because at the time I still thought that I can do some things a little bit different and not sort of learn from them. So I should have listened better. So as they told me at the time, you will need to burn through a couple of things before you really know how it works. And this is what I did. And so the first fund, Energy Venture Capital, was not a failure, but there were still a couple of things. We had 5 insolvencies, for example, and that's really tough. You need to get through this. We had also 6 trade sales and 1 very small IPO, but still, so I learned it the hard way. And then the final step, of course, in EnBW New Ventures. This is when the chief innovation officer actually reached out to me and said, hey, what you've done in Energy Venture Capital is cool. We have all the internal innovation tools, but we are missing the external investment arm. And this is when I then had the chance to meet with the board members of EnBW and to actually learn and understand what they're thinking about venture capital, to propose how I would envision to build it. And this was a great fit. And since then, I have a lot of fun and hopefully also a little bit of success in building EnBW New Ventures.
Very nice. So I would be asking what you learned from the first CVC into the second CVC. But before that, from your background, I want to understand your chemical engineering background. How does that help you to invest the way you do today? And also, I know from previous discussions that you also had an MBA. So how does that combination helps you?
Yeah, first of all, I think this is as an investor. I mean, I think there are different types of investors, but the one type that I maybe represent is sort of having a pretty general toolbox. So understanding technical aspects very well, but also understanding the economical impact and how to actually scale and drive a portfolio company where maybe the founder teams and the entrepreneurs could have a look at. So it's both aspects. I think it's like a 360-degree toolbox, which helps a lot. But when it comes to sort of the chemical engineering, especially, I think engineering is about efficiency, is about conversion rates, is about sort of using technologies that you can also realize. So it's not sort of just the thing in the sky, the castle in the sky, but really having something that you can then also put on the ground and actually get it running. So having an eye for things that actually will work. I think this is a piece that helps a lot. And of course, as an investor, we are in the infrastructure, so energy, mobility, or infrastructure world, even though we don't do the heavy lifting as EnBW Ventures, but we do more the digital enabling and scaling things. But still having this sort of basic knowledge, I think, about the mechanisms and about the logics in the energy world is very, very important. So that's this piece. But there are many, many other traits of an investor that are very, I think, very difficult. It sounds sometimes so easy, or when other people tell you, you think,
from the outside world, yes.
Yes. And then you do it and you think, oh, it's not easy. And just one example, when you talk about active portfolio management, and I think this is absolutely key, even for a relatively illiquid asset class as ours. But active portfolio management, so really looking on the investments and each quarter thinking about, okay, so what is running well, what is running not so well, and putting your money on the things that run well, and not taking all your time on the things that do not run well. That's sort of something that is like as human beings, our basic emotion is, oh, there's a problem, we need to solve this. And not, oh, this is running well, how can I scale this even faster and even further? And this you need to do as an investor. And that's one of these simplistic examples, but it's so difficult to do in real life.
Yeah, no, I agree. This is actually part of the venture capital discipline, also to help the ones that are succeeding to succeed even faster and bigger. So talking about bigger and bigger, part of your career is working on projects that needs to scale. Today you invest, I think, in Series A and onwards in projects that are about to scale. How much of that experience on your previous career, the first part, is helping you today both to identify the right entrepreneurs, but also the right projects?
Yeah, I think, and that's a piece of it. I mean, you know that from your interviews and generally from your business that there are many different ways into CVC or into VC generally, but your own experience plays a role. So bringing sort of sector expertise in the energy world, having lived through and having been part of a company that actually has increased their business and their employees by a factor of 6 in a couple of years. That's feeling this strain and knowing about this strain, I think, is quite important when you talk to entrepreneurial teams, because I think it's just amazing what these teams are doing, and their commitment and the risks that they are taking. And I think this needs to be acknowledged. And when you have lived through pieces of this on your own, I think it helps. But I said before, there are different types of investors. I'm a portfolio manager. This is completely different from, there's also some investors in our community that really say we are entrepreneurs on our own, which is a value proposition, but it's a different one from the one that we are bringing. So we sort of can bring experience out of all the deals, and of course, getting consortia together and so on. We can bring sector expertise. We can open doors to EnBW, to even more experts on certain matters. But we would never claim we are also entrepreneurs. This has the big advantage that the responsibility on taking the entrepreneurial decisions in the startups rests 100% there. We're not a corporate VC that thinks that we know anything better there. We are just sort of trying to share what we have seen before, what has worked, what has maybe not worked, but the decision stays with the founder team, and it should be also there, because after all, we're just an investor and trying to facilitate and help to increase the probability of their success. That's our business.
Actually, I want to touch on that. Indeed, we are minority investors. We are not majority investors. But there is a temptation, especially when an investor knows a business well, to feel like they can influence the strategy of a startup they invest in. how do you feel about that temptation, and how do you make sure that you stay that disciplined investor versus the one that wants to drive everything?
I think I have experience, especially out of my first fund, where we went also, our sweet spot is we start below 10% and not 2-3%, because we are still an active investor. We like also to take board seats if that is possible. It's not a must, but we are happy to do so. We also lead or do co, but we also lead. Some CVCs never lead, but we do that. But this is more thesis driven. So basically what we do is when we talk to the entrepreneurial teams, okay, what's your vision? Where do you want to be? And then in 3, 4, 5 years, and we don't take the exact numbers, but it's more like, okay, do we share that vision? Do we think that this could really work? And then we are in the here now, yeah. And then we really discuss, okay, what is there now? Which logos do you have? What is your growth rate, and so on. So we're looking detailed. We're not sort of very completely hands off. But all this discussion is geared towards sort of having transparency and added value for the entrepreneurs on how they can steer their company at the end of the day. But they steer it. My own experience in having a too large share, above 20%, it starts to get dangerous. Above 25, it's an absolute no-go. Because then it starts to transform into something which is more like a type of a subsidiary, which is absolutely not what we want. I mean, there is other units in EnBW who are managing participations, minority and majority, I don't know what. We're a VC investor, so the team is driving the growth, and we are financially driven. I mean, we understand the thesis and we have a frame in our investment strategy, but we are a growth investor at the end of the day, and financially driven. So I always tell the founder as well, it depends on what you are looking for. So being financially driven is very nice as long as you deliver. If you don't deliver, we're not your best friends. I mean, we need to make money. You want to make money. We want that your startup succeeds. That's our only focus. Yeah, there's not a strategy thing for EnBW that we're trying to deliver with your startup. We see potential in what you do to do more with EnBW and so on, but that's your decision. That's the decision of the operational units. But at the end of the day, you have here a business plan. We make evaluation. We give you money. You need to deliver on this. So as long as you do, great. If you don't do, well, we are financially driven investors. So we are here also to discuss problems and issues with you and look for solutions. But then it gets harsher. Yeah? So we're not a strategic that just says what you do is what we want, and whatever is the result, we don't care. So that's, I think, a very, very important message. And there's many very different CVCs out there, and with different theses, and that's fine. And there's not the one and right and only, but we are one of these pretty financially driven creatures, and therefore taking over strategic control is absolutely not in our interest. And when I have done it in the past, it was not good.
So it's good. You learn from mistakes, and you know the value of not taking control. I think so. Part of what you say, which is, I think, is implicit, is that you never invest with a commitment or an obligation for the startup to work with EnBW. And maybe you can speak to why this is the case, because I know it's a best practice, but I think it's good you explain why you think that's the case.
Yeah, I mean, so first, I think what is quite important, and this is what I mentioned before when EnBW was contacting me, if I could, if I would be ready to sort of build EnBW New Ventures. I think it's very, very important, and this brings me, by the way, also to another piece that I wanted to mention. It's very, very important to talk to not only one board members. The best is to talk to all the board members and understand what do they expect from this tool.
And do they expect the same thing?
Exactly, and do they expect the same thing? I was lucky enough; I had the opportunity to speak to all the 4 board members, and I was sort of there were different messages, but the overall message was fitting to the business model that I'm believing in. This is extremely important. Being dependent only on one board member, difficult. Then the second thing is, and this is the case in EnBW, there is, I think, CVC is sometimes used as a big word, meaning many different things. So the real situation is that there are many corporate innovation tools. So there's incubation, there's venture clienting, there is also sort of acceleration, how some people call it, and there is venture capital. And I think units, whenever I talk to others heading CVCs, when you put too much of the general innovation strategy and sort of cultural change things into the CVC, then it gets a multitask and it's very difficult to deliver. In our case, the whole piece of incubation, acceleration, strategically sort of building internal teams, like corporate projects, all this and dealing with the innovation strategy, all this was already there. And our task was really investing into external startups. So a pure, sharp CVC approach. And I would always advise, sometimes, you have to take a road, but I would always advise to clear exactly which innovation business model has to be pursued here. Is it really CVC, or is the C-level looking for something different? Which is valid, but it's just something different than CVC. And I would also never argue that you need only the one or the other. I mean, I have a personal opinion on some tools being more successful and some less, but the corporate can decide which tool they want to use. But then they should really exercise this tool as professional as possible. And I think this is very important. And finally, the third point, I think in the beginning of a CVC, it's really important to understand what's the basic motivation of the corporate. And I would say there are two classes. One class is the corporate that is, the business is running so well that they have so much cash right now that they think, let's get innovative. I'm making a little bit too much here. But
it makes sense.
And then there's the other one that is sort of in a very difficult situation. Core business model under attack by new entrants, by innovational change, by new technologies going into the market, being really under the pressure and asking yourself, okay, we need to change something, but how? And this is second class. And my first CVC was the first class, and my second CVC was the second class. And I would really advise, or I personally think it's easier to start a CVC with the second class because there's not an innovation theater, but it's a real need. And there's also the patience. And I mean, there's pressure in the business, but there's the patience that there's a need for innovative solutions, for new solutions from startups to cooperate and so on. While the other one is sort of more like, yeah, we're nice and sexy. And this, the probability that you get under pressure, not by own wrongdoing, but by changes in the corporate is, I think, in the first class much bigger than in the second class.
And I think in the second part, you're probably getting more buy-in and sense of urgency from the business group inside the mothership.
Yeah, exactly. Exactly. Yes. Fully agree.
Yeah. Well, one thing I want to ask is, because that's super important for investors, you talk about being super focused, but it goes beyond that. It's about building a thesis, which of course comes from what I like to call the superpower from the mothership. How do you build your thesis?
Yes. Bear me 1 second with your last question, because I have not fully answered it. I would.
Yeah, sure.
Because you asked basically why there's no forced cooperation between the corporate and the startup. And I think this is super important because by sort of talking about the setup, the corporate is very much focused on his own pain points and things, and that's for a good reason. And we as a CVC, we focus on the best entrepreneurial teams, and we must have the operational freedom to invest into these best teams. And then to force it and say, but you two need to work together, otherwise we either cannot invest or I mean, we are way too small in a way to ask an operational unit, you have to. I mean, it is our task to understand their pain points and to put a certain probability that it could work out. But this hard wired connection, I think, is very difficult because it eliminates the freedom that both sides need. The startup, I mean, when we are an investor in the startup and we start at a certain point and then they see their product in a different market works much, much better, then we are an investor and we say, okay, go for it. I mean, make gazillions in the other market. If we would say, no, you have to stay there because there's this cooperation with my corporate, you have to stay there, that would not add any value, not to the startup, and on the long run, also not to the corporate. So we understand our business more like offering options, and offering successful options. So if I offer an option to work with a startup that is not successful, that doesn't help anybody. And on the other hand, I think I don't want to, and I don't think it makes sense to force anybody on the operational side, because yes, if they are forced by C-level to do something, they will, but if they don't believe in it, then it will never scale. So these are the reasons why I'm a big fan of, I'm responsible for the CVC business model. I need to make money, and this is what I need to deliver. The operationals are responsible for their business. It's not on me to tell them what works better or not, but I have to find things that are just so convincing and great products. And I know their pain points because I'm part of the family, that then there is a certain probability that it actually works out.
Yeah, I've never experienced a sustainable partnership where you force people to partner. So I think the way you describe it is you create a context where the partnership can happen, but you want both parties to want that partnership.
Exactly. And this is hard work, and it's not easy. So this, I guess, I would say that this is maybe even the most difficult piece in the setup of a CVC. And Nicolas, we spoke a little bit more than 2 years ago. We spoke about about TDK Ventures and about EnBW Ventures, the setups. And at the time, we touched exactly on this point. And I asked you, how have you solved it? And you were explaining to me engagement management and how it works. And actually, I took this really as an advice, and we started sort of being much more active there and have our own engagement management now. So this was really a very, very important hint from your end. And this is
I didn't know that. Thank you.
Yes.
I think the engagement team wake up every morning excited by the potential to create partnerships. And the way we look at it is we call it equal win engagement. And what that means is most people talk about win-win, but typically it's a small win and a big win. Guess what? 2 years later, whoever gets a small win will leave, and whoever thought they had a big win have nothing. Mm-hmm. And so you really want to have these equal win engagements where both sides really want to work. They identify real value to create together, and then it's going to be sustainable for a long time. And if you think about the true value of a CVC when you create partnership, is this kind of partnership that becomes really, really valuable over time, where the startup becomes this unicorn and this major market player. And then you really have crystallized maximum strategic value on top of financial value.
Yeah. And it's really difficult to do. So I'm still learning on this end also, even in my 16th year. So, and I guess it will continue. I mean, I've spoken to some people that are doing this 25 or 30 years and they're still learning. So yeah, it's amazing. But I think this is a very, very important piece. And this is where only then strategic and financial value comes together. And so, yeah.
Any tips from this journey of improving the engagements you want to share?
Again, I think we're maybe you can share more than I can because you're doing this already longer and probably even more successful. But I think the starting point is what you just said. like the CVC is in itself a VC business model. It's a transactional business. It's buying and selling. It's of course also being long time sort of partnering for 5, 6, 7 years in order to grow together. But it's a transactional business in itself, while the engagement management is something different. It's completely different. It's much more product and pain point focused for the corporate. And I think it needs different qualities. So it's really sort of the being excited about sort of the future aspects is the same for both teams, but the characters and the education that you need in these teams is very different. And I think this is important to take into account when you basically build your team. And the team is same with the entrepreneurial teams, but also for the CVC, the team is the most important, that you can actually connect well on the sort of key topics of the corporate and on these logics, but that you are really, like what I always say is, I'm looking for people for my CVC team that they are really excited about VC and the startups and the entrepreneurs, but they're also very excited about the corporate. So you cannot, if you are a CVC that really wanted really to be a VC but just didn't make it, or so, that doesn't make any sense. So you must be excited for these two things bringing together and adding value.
I think it's not a tip, but maybe it is a tip. I know that I've recruited the right person for the engagement team when I can see how excited they are to work with TDK, and they discover solutions inside TDK, and they're like, wait, this could be useful for this portfolio company. And they love to connect the dots. Mm-hmm. And so I think that when you recruit people who are curious, passionate about the topic, and they love to connect the dots to create value, I think that's really a good sign for an engagement team.
Yeah. And here again, I think in order to be down the road successful in this engagement, it's two journeys, or it's two things that you need to do in addition. One is being really good at your VC business, because only when you have successfully scaling startups, getting into the maturity that is the right one for the corporate, you can at all expect cooperation. And you need to take the effort to be in close touch with a C-level, but also with a strategy team and with the sort of individual operating strategies of the corporate. You need to want to understand this and maybe even contribute and discuss with, and being part of that. So you need to be present in both worlds.
Actually, let me push you a little bit more. Why do you need to be a good financial VC to then have a chance to be a strategic VC?
Yeah, I mean, this is this famous question that we're always getting, and I'm always sort of a little bit downbeat when I hear panel discussions that then say you have to be strategic as a CVC and stuff like this, because it's such a delicate issue at the end of the day, and it's not and or. So sometimes people tell me then, yeah, you're a financial VC, but that doesn't work then with the corporate and so on. I said, no. it's really, please, let's discuss one level deeper. And this is the core to it is that I think what we're describing always with this corporate VC activity is that we're looking for this win-win. We're looking for this, that the things come together, not forced, but so, and you need to create not only one, but many options in order that it works a couple of times. So that's the first thing. We're back at the portfolio level. But it's obviously, if you sort of connect the dots and people are interested and they expect a lot, and then sort of if the startup is failing and is not successful, then it has bound corporate resources in addition, and sort of a failed partnership can destroy a lot of trust, and that is long time to rebuild it. So this is why you need, as a VC or CVC, you need to think really about your maturity stage. Where do you invest? In order to not sort of open up this too early. So you need to be conscious about the precious time of the corporate colleagues as much as about the precious time of your entrepreneurial team that has always resource constraints. And so you should not sort of throw this thing around and think about, I opened 200 times the door, but really about okay, what could fit and why. And I think the enabler to having impact on the corporate is the success of the startups. So back to square one. I just think it's the other way around than, okay, having a strategic thing. Still, you can take the strategy of the corporate into account. That's not the problem, but more as a frame in your investment strategy, never on the individual startup level. That's, I think, one of these key things. And where I always sort of, yeah, but it's an and, you know, it's not an or. So as a CVC, we must understand both sides. But if the startup portfolio is not successful, then you cannot do anything with your and.
Very nice. So I want to talk about a few of the very interesting design decisions you made, but I want to go back to my question about thesis. How do you build a thesis and maybe leverage some of the superpowers that comes from your mothership?
Yeah, I mean, I think the very first step is, of course, and I mentioned this before, is to understand what is your corporate. Yeah? And in our case, it's, to make it in one simple sentence, EnBW is an owner and operator of complex infrastructures. So very capex intensive, very complicated, big projects. That's their business. And I think this is the first step that is incredibly important to have this always in mind. So we will not try to change the basic business model of our corporate. That's not our mission. But we want to ensure that they can be successful in their core business. And then I think it's important as a next step, okay, so where can then the CVC unit add value? And I think then comes immediately into play the question, what fits to the VC business model? And there is, of course, two types of VC investors that I would qualify more like. One type is taking pure technology risk, really deep tech funds, can be very successful. One type is more taking execution risk, with a little bit of market risk maybe. And we're the second type, clearly the second type. And I don't say it's one or the other, but I think it's extremely important when you look on the business model of your corporate that you add a CVC that fits. So a deep tech VC investment activity would not fit to a utility. It just doesn't fit. The utility is not a technology player. A technology player, I guess probably like a TDK is, needs also deep tech technology risk. And I think this needs to be acknowledged, and this is the design decision already. And in
we don't need deep tech risk. We just need to understand it well enough to assess a risk-adjusted valuation.
Yes. And you, of course, have with your a technology company behind you, experts that can help you in that.
Yes,
and
absolutely.
We have experts that sort of are more on the execution side of things and are building large infrastructures. And we are trying to find startups that can actually help there. And this is part of the original thesis. So you start with, okay, and then what we add into, and I've mentioned that also before, is we always look on the 3 megatrends. So perfect startup is that plays with all these megatrends. Okay, if it's only 2 of the 3, also fine. But why it's so difficult to build a successful startup that we want to have tailwind. We want to have sort of the big trends should be with us. Then it's already so difficult to build a startup, but then it's at least not in addition that you have fighting against a certain trend all the time. And of course, when you are with a mega trend, the market and the value sort of generally is increasing. So even if you get a small share, you can still build a nice big company. So this is a next point. So if you look at our individual thesis, so let's take, for example, we're right now quite excited about sort of the whole rollout of batteries. And that's not just in cars, that's stationary batteries, that's omnibuses, it's basically everywhere. And sort of when we look at how PV has over-delivered year by year, we see the last 5 years also batteries are over-delivering every year. So we don't invest into battery chemistry. That's not our topic. But we, of course, look at this and we understand, being a chemical engineer, that batteries are quite complex assets. Yeah? This is not like a PV module that you put there and that sits there for 40 years. A battery is very complex, needs care, and needs operating know-how. And this is why we have, for example, invested into Volutica Diagnostics. They are taking all the sort of data out of the battery, and they are trying to ensure and simulating to give you feedback. Is your battery delivering according to performance? Is your battery safe? Are you within the warranty? And of course, when you optimize the battery on the market, you need to understand, okay, this additional cycle, how much does it cost and how much can I earn with it? Because you need to make money as an asset owner. And so they are delivering this piece. And then we have invested, for example, in another company called Inspired. They are doing the market piece. So they are putting fully automatic the battery in a trading as a service business model onto the intraday power trading market. Yeah? And these both together, then it's basically the revenue and the cost side. And we know, of course, we have a whole unit that is right now working very, very hard on bringing the battery hardware into the field. And this is sort of where we interconnect our thesis with sort of the trends and with the know-how of the corporate in order to have a little bit of an unfair advantage as an investor also.
And actually, this unfair advantage is probably why you invest at Series A versus Series B. If you didn't have this unfair advantage, you would want not to be the first customer. Here, you probably can afford to be because you understand the tailwinds behind.
Yes, and I mean, it's the question of how you define Series A. This is also a little bit sort of differing from time to time. So we're not doing seed investments. So that's what we definitely don't do as EnBW New Ventures. We have actually in the corporate, there's a special group that is also looking on the very, very early stuff. So that's also taken care of within EnBW, but we're not doing this. And we are looking for companies that have already customers and sort of first returning customers. But we are trying to be just in front of this acceleration scaling phase. And this is incredibly difficult. Sometimes we're also wrong, it's for sure. But when you hit that one, it's real fun.
Very nice. So I want to go back to the fact you had done one CVC. You probably learned a ton. And then you're offered to start a CVC. So you really have a chance, not just to talk to the board of directors, make sure you have a good alignment, but design it the way you think it should be done. And so if you could share maybe one thing that you learned that you for sure wanted to do in the next one, and something you knew you would not do again.
There's not only one thing, but yeah, I mean, you know this point already because we have discussed it bilateral. But I think there's one thing. I'm a big fan of setting up a CVC as close as possible to the traditional classic VC model, because that's the business model. So be as close as possible. But then there are a couple of things that I think a CVC should do different. And one very big point is we are set up as an evergreen. My first CVC was a traditional closed-end 10+2 closed-end fund. And what I've learned there is that this traditional thing of you have this investment period, so you need to invest very fast and get all these portfolio companies in. And then you have your divestment period that the whole market knows you need to sell sooner or later. And sort of, in my first fund, I thought it's important to have this because I thought this puts this natural pressure on exits. And I was fearing a little bit that the corporate could sort of, this sort of hang around thing. So why don't you just continue? And I thought a closed-end fund is good because then we're forced to sell. Well, this we changed. We're an evergreen, and evergreen. Maybe I spent 2 seconds on explaining.
No. I have a question on evergreen, so we'll go to evergreen for sure.
Okay, good. So that was one big change that we did, and that up to today, I would say it was a real valuable change. So it was a good decision. And then another thing is with portfolio management, where in my first fund I was not so strict. And if you get overexposed on one portfolio company cash-wise, you have to absolutely avoid this. So again, this sort of simple logic, push more money into the really good cases, but always look on, while you're moving, you're originally getting a certain cluster risk because of the successful ones are the big ones in your portfolio. But don't get overexposed in the terms of your initial cash allocation. So scaling in is absolutely key, because you can do the best due diligence. You can even have witnessed the team 24 months before already. You want to scale in, you want to see the live performance, you want to sort of step by step build your position, and not taking a big check in the beginning and then figuring out that things are different than you thought.
And that leads very nicely to evergreen, because I find the evergreen concept to be, on one hand, so simple to understand, but so difficult to operate, including on the pace of investment. So do you mind first sharing with the audience what is an evergreen and how did you set it up?
Yeah, so the very first definition of the evergreen is very simple. It basically just means it runs forever. He is forever green. And so there is no time limit on the fund or on the legal entity that you're operating. That's the first thing, but it doesn't end there. The second very important piece is that I call it always, it's a closed business model in itself. So it's a reinforced and in itself closed business model. Why? Because basically, and that's especially, I think, good for a corporate, you go to the corporate and they allocate and commit a capital, for example, 100 million in our case. And what I then did and told the board of EnBW, thank you for this commitment. We are an evergreen setup, so you will never see me again asking for more money. Why? Because you have this capital commitment and you need to build your portfolio according to this size, also with your further scaling into the individual startup cases. But then you, after year number 3, 4, 5, you come also with the exits. And now comes the magic. When you have the exit, assume you have invested 10 million and you sell it for 20 million. You then afterwards have 10 million more. So you're not a 100 million fund anymore, but a 110 million fund. Yeah. And that's sort of the big advantage, because you can basically fuel your own growth as a fund and your next fund out of the exits of your first fund setup. And this is, I think, very strong tool also for the corporate, for the C-level, to basically tell them, well, I'm not only telling we will make returns, but actually we depend on, as a whole unit, on the cash on cash that we're delivering, because otherwise we cannot invest. And my whole team knows, if we're not delivering, then we shrink. So if I lose the 10 million, then I'm only a 90 million fund anymore. So it works in both directions. And the corporate knows, okay, I risk this once, but then I can really witness and see. And even if it's successful, I don't need to put more. It basically fuels itself and it's getting larger and larger and more important. And I think this is the beauty of it. And for the corporate, but also for us and for the whole team, because it's for us, it's also accountability. You know, it's not hoping to go against, because we are a single LP fund. I mean, other corporate VCs try to take this risk a little bit by having a multi-LP fund. I think multi-LP is, I mean, it's a challenge. Yeah. So because they probably have different interests. And so you deal not only with one corporate organization, but with 2 or 3 or 4. So, I mean, it can be made successful. There are examples, but it's a challenge. So I clearly opted for single LP, being part of the family, but at the end of the day, having this closed loop. And then there's one difficulty that comes with it that you need to solve. And that is, how do you measure performance? Because, of course, we are like a classic fund, so we draw and then we invest and then we sort of redistribute immediately to the corporate once we have made the exit. But how do you measure now? Because you're always sort of redrawing and reinvesting. So how do you measure success? And there, of course, the answer is you don't need to reinvent anything new, but you really need to just apply the traditional metrics of a closed-end fund onto your evergreen, and you build cohorts, basically.
Yeah, no, that I think is quite straightforward. I think one of the biggest challenge I see, especially in 2022, 2023, you don't have so many exits. And if you didn't expect that, you may end up with very little you can invest right now, while actually this is probably one of the best moments to invest in startups at the right valuation. So how do you pace yourself to make sure that you take that into account?
Yeah, I would even argue a little bit the other way around, that when you know that you have a limited capital and you will not fundraise into the next fund, that you work with this capital in a much more controlled way, that you're really looking on, okay, so we always look into the next 2-3 years and have to ensure that we have enough capital for all the portfolio companies available. That's what we have to do. So because there can be always 1 or 2 years where exits are not possible. On the other hand, the good thing with the evergreen is that it's only value driven. So my corporate doesn't expect from me that this capital is all invested. So I can pull the trigger value driven and not time driven. And this is different with the closed-end funds, because I mean, if the closed-end fund would basically draw the money and then exit everything after 5 years, then the investors would say, we wanted to invest for 10 years. That doesn't work. So for us, it's only value driven. So taking as an example, on the buy side, we are very constant. We're like a German beetle, every year 3-4 new investments. And we have not accelerated 21 in the frenziness, and we have not put the brakes in, or will not put the brakes in 24. So we are just steady. But on the exit side, we follow sort of the timing. So when we saw these incredible valuations, 21 and 22, well, we just sold some of the companies. We didn't think that we would sell early, but I mean, the price was right. So we just sold. And this is why we're happy to have a couple of successful exits. And then after such a booming period, if you use it with the exits, then comes maybe a much more difficult period. But logically, you have some of these exits already under your belt. So yes, a little bit of luckiness is there, but that's for the closed-end fund the same. I mean, try now to raise a closed-end fund, more difficult than in other years.
No, I think it's a golden nugget, which is evergreen drives a value-based decision-making.
Yes, because we have this limited capital always in mind. So we always think like, okay, we could make now a 3x. Is it worthwhile to stay in for the 4 or 5x? And how fast will this come with this company? How fast? Exactly. The time is always incredibly important for us. Or do we want to redeploy this in new opportunities? That's always the trade-off.
Which actually is the opportunity cost.
Yes. Yes.
Yeah.
I think it's really, and this is also the experience. I said, maybe we were lucky now that we had already a couple of years before these boom years to build a portfolio that we could now use the exits. So I would still say the corporate must have the trust for at least 5 years to let the team do their job. I mean, you cannot just prove it in 1, 2, 3 years. But if you get this trust for 5 years, then you should be able to show something.
Every evergreen fund I've interviewed or I've asked questions, they are always extremely happy to be evergreen. So clearly there is a piece that comes with being value driven and taking your time and not being rushed and making the investments when you think they are the right investments versus being time pressure to do so.
Yeah.
Now let's talk about time pressure, because you report to a CFO, and most people would think that reporting to a CFO means time pressure, financial pressure. Now, maybe with the evergreen, you kind of have the best mix of the two. So maybe you can share about the CFO reporting. And of course, your CFO, I think, has been voted the best CFO of Germany. So clearly you have a good CFO. But if you can share how you think about the reporting line to a CFO, the pros and cons.
Yeah, actually, also this has evolved. I mean, it's always sort of getting experience, and of course there is this effect of this personality. So I have not reported to 10 different CFOs that I could now say how this is. And I may be very lucky that Thomas Kusterer, who is the CFO of EnBW, is actually the one that we are reporting to. But when I take it more abstract on a sort of, I think there is the notion for me is that it's the question of how modern the organization is, because a modern CFO is about capital efficiency, but is also about sort of not only looking on risks, but looking on the balance of risk and reward. I think a modern CFO should do so, and therefore the CDC instrument, which is from a capital efficiency point, clearly the most efficient innovation tool out there, I think already there you could make the case and saying, well, it should be actually with a CFO, because, and that's now the second piece, we are an investor. So we draw capital, we need a capital commitment from the corporate. So also there, the license to operate is coming with the capital and is coming from the CFO. Of course, we know about the innovation strategy, we know about the operational businesses and so on. But and many people argue that it should be the CEO. But the point is that if you have a modern CFO who sees himself as an enabler of the business and of being as much also impactful on the strategy as others in the board, I think there should be no detrimental effect to this. And this is, I think, quite important. So all these things, and in the sort of, I mean, of course, he's not, and this is, by the way, a very, very important point. When I say reporting to the CFO, he's not looking on our deals. He is the representative of the shareholder, and we are 100% subsidiary of EnBW, single LP. So he's the representative of the shareholder, but he understands our business model the best. So he can challenge us also the best. And he's talking about the general setup with us and about the general performance, so the returns that we're delivering and so on. But he's not talking with us about a single startup. That, I think, that's another thing where it depends on the corporate. But my experience is that having C-levels in the direct decision of single transactions in the corporate world is suboptimal, because these C-level guys, they have a wealth of experience and network, but there are many zeros more on the table normally, so the deals are just way too small for them. And when then the result is that they have not the time to really look at it and deliver the value, then I think there must be a lot of support with the C-levels, but not in the daily operation and transactions of the CDC. There we have an investment committee actually to deal with this.
Very nice. Who is in your investment committee?
Yeah, I mean, there again, you can ask about the setup and so on. So we are a GmbH, which is a legal liability company, and sort of I'm the managing director. So the team, the investment team, sort of submits deals to the investment committee. So the investment committee is not telling us, here's a deal, you have to do it or so, but it's really coming out of the team. The deals are there. But for every transaction, we need a support of the investment committee. And then the question is, how do you set this up? How have we set it up? We have 5 members, and there's 3 from the corporate right now, and 2 are externals. So we have one, basically an investor slot, which is an ex-early bird partner in our investment committee, and the other one is an entrepreneur's slot, who is an entrepreneur who is actually also an ex-consultant partner, knowing utilities very well, but has built his own digital company. Is sort of, it's large now. He has moved into more like the advisory board and had time to actually also support, and he's also an angel investor on top of it. But so he's more the entrepreneurial angle, always looking on sales performances and so on. And the other one is an international investor experience. And the 3 EnBW members are not responsible for business units. They are responsible for overall transformation in EnBW. They are responsible for transactional business like finance and M&A, and they have a legal background. So this is sort of the setup. we have generally a discussion, or sort of the thinking is always that the investment committee makes us better. So the discussion and the sort of exchange with them, and the discussion also with the startups. So they are pitching also in front of the investment committee, because at the end the entrepreneurs can sort of transmit the value and the story much better than we ever could. But yeah, this is the setup. It's not exactly like a VC. But what we need, and this is typically on EnBW side, VP level, so one level below the C level, and that's because they must have decision power and experience, and standing, also as our multipliers in EnBW, but they should still be excited about this and having the time to react fast, because we have quarterly meetings, we have monthly updates, we have so-called Umlaufbeschlüsse, so that we at any time we can basically drive a decision and get a decision within two days or so.
Wow, this is fast. So this is very interesting. I think it's the first time I hear about an IC of 5, where the 3 are corporate but not attached to business group, and 2 external with investment and entrepreneurs mix. I think it's very, very interesting. Thank you, Crispin. We are reaching the top of the hour, so thank you so much for sharing with us all your journey, the tips, the best practices, what you learned from the first CVC into the second CVC. Thank you so much, Crispin.
Thank you, Nicolas. Pleasure and fun, and I'm sure we'll meet again. So thank you for the opportunity.
Absolutely.